Welcome to this explainer. Okay, with the market surging and some portfolios literally hitting all-time highs, look at Jeremy's $4.6 million public account. It is a seriously fascinating time to see exactly where capital is flowing. So today, we're diving headfirst into Jeremy's massive deep dive stock rankings. We're going to see exactly how he organizes all this market chaos to pinpoint those absolute long-term moneymakers.
Here's the roadmap for this explainer. First up, the long-term rating rules. Second, the generational strong buys. Third, disruptors versus the disrupted. And lastly, the core principles of investing. Let's get into it.
Section 1, the long-term rating rules, time horizons, and the 1 to 10 scale. Okay, let's dive into this. Jeremy's ranking system leaves zero room for ambiguity. It's totally black and white. A 1 reading, that means a stock is fundamentally broken. You wouldn't touch it with your worst enemy's money, right? On the flip side, a 10 is a literal mandate to load the boat. We're talking a once-in-a-generation buying opportunity. Contrasting these extremes right out of the gate really shows you the true stakes of the numbers we're about to look at. And we need to talk about time frames, because the investment horizon for these ratings spans 5, 10, 15, or even 20 years out. This framework completely, and I mean completely, ignores the noise of next week or next month. So if you're trying to build a trading strategy based on, what the market might do next Tuesday, this analysis is not going to align with that. This is strictly 100% focused on massive long-term wealth building. Moving on to Section 2, the generational strong buys, the 9 and 10 ratings.
Kicking things off with an absolutely massive 9 rating is Amazon. This is a foundational core position in Jeremy's portfolio, and it's really driven by the thesis that their AWS business, their cloud computing arm, is just perfectly positioned for exponential growth. And then, of course, on the retail side, their end-to-end e-commerce dominance operates on a scale that is just, it's virtually unstoppable.
Now, what's really interesting about this slide is the philosophy here. It's incredibly simple. Amazon's always a buy. It is wild to think about, actually. They were famously criticized as being completely overvalued during the dot-com bubble in the late 90s, right? But then they were considered a solid buy in the 2000s, and they remain one today in the 2020s. Finding a company with this kind of relentless growth trajectory, especially sitting at a forward PE in the 20s, that is rare. It makes it a deeply safe, foundational stock for this entire strategy. Next up in the Elite 9 Club is Meta. And wow, Jeremy's public account has seen a staggering 572% gain here. The numbers driving this elite rating are just phenomenal. We're talking revenue growth expected to be just under 30% for the next 12 months, and their earnings per share growing even faster than that. All of this while it's trading at a forward PE under 20. But there's a catch. Meta has this really unique catalyst hanging over it, the CAPEX question. So right now, the stock is kind of drifting sideways, largely because Mark Zuckerberg is pouring massive capital expenditures into new tech, and honestly, the market is a bit hesitant about it. But the working theory here is that the very second those spending questions are answered, or if that spending is pulled back even a little, this stock becomes a coiled spring just waiting to explode past $1,000. All right, brace yourselves, because we have reached the incredibly rare, highly controversial 10 rating. Coming in with absolute maximum conviction, Jeremy is officially designating Nike as a true load-the-boat generational buy. And this brilliantly illustrates a serious contrarian viewpoint, the idea that we will look back at 2026 as a generational buying opportunity for this company. Look, with the stock battered and trading down in the low 40s, this framework is telling us that this is a once-in-a-decade chance. It's your opportunity to accumulate shares in a legacy, totally dominant global brand, while everyone else in the market is panicking. Okay, let's rapid fire through a few other high-conviction buys on this list, just to prove that massive upside exists in totally different sectors if you know where to look. ELF Beauty is sitting at a 9.5. They are an absolute growth beast, on track to become a global cosmetics giant. Celsius, also incredibly strong at a 9.5, is primed for massive international and brand expansion. And then you've got SoFi, sitting at an 8.5 as they aggressively scale into a next-generation financial giant. Section 3, Disruptors versus the Disrupted. The risks of AI and automation. Okay, shifting gears here, because protecting your capital is just as crucial as finding the winners. A massive 5-year threat to watch out for is mass robotaxi deployment. Companies like Waymo, Tesla, and Amazon Zoox are quietly and rapidly building out these autonomous fleets. Over the next 5 years, we aren't just talking about cute little test projects anymore. These are expected to deploy at a massive scale, and they are poised to completely upend city transport as we know it. So the crucial point is this. You absolutely have to understand which side of the automation revolution a company actually lands on. Take ServiceNow, for instance. Rated an 8.5, they are a software company perfectly utilizing AI to thrive, keeping themselves completely central to massive corporate operations. But then contrast that with Uber and Tesla, sitting way down at a dangerously low 3 rating. Both of them are actively facing severe disruption, slow deployments, and what looks to be really messy growth ahead.
And Jeremy highlights a brutally harsh truth here, especially for a company like Uber. If a company is being disrupted, its PE ratio is completely irrelevant. Seriously, it doesn't matter how much cash Uber makes today, or if they eventually trade at a seemingly cheap forward PE of 7 or 10. If direct-to-consumer automated fleets from Google and Amazon just swoop in and replace their core app tomorrow, their valuation is going to plummet. And it will stay depressed, much like New York taxi medallions did when Uber itself first arrived on the scene. The market simply will not pay a premium for a melting ice cube. Let's move to Section 4 and see how this builds core principles of investing. Jeremy's framework for success. If you want to succeed long-term, you need resilient architecture for your portfolio. Jeremy's approach to this is the GVD strategy, which stands for a balanced blend of growth stocks, value stocks, and dividend stocks. Balancing these 3 specific pillars is exactly how Jeremy built his multi-million-dollar public account. It creates stability. If your growth stocks take a hit, your value and dividend plays step up to stabilize the ship, totally preventing a single bad market trend from wiping you out. Let's break down these non-negotiable rules really quick. First, stay diversified. This is literally your long-term alpha. You can't rely on just 1 or 2 hot stocks to make you wealthy. Spreading your bets protects you from the unknown. Second, and this is big, conference calls are mandatory. If you aren't putting in the hour-long work to listen to these earnings calls, you're basically flying blind. It's the only real way to truly understand a company's high-level strategy. And finally, expect losses. It's just the cost of doing business in the stock market. You don't have to be perfect, you just have to be right more than you're wrong and let your massive winners completely overshadow your mistakes. Which brings us to a final, really important question to ask yourself right now. Looking 5 to 20 years ahead, is your portfolio actually packed with generational buys, or are you secretly holding the soon-to-be disrupted? Take a hard, honest look at your holdings. Audit your strategy using the GVD framework and make absolutely sure you're positioned on the right side of the future. Thank you so much for joining me for this explainer, and keep building.